Well, so just before we begin today, a couple of things that I want to go through. I had a question from one of our students, which I promised I would answer in this lecture today. And also just want to keep you guys in the loop on the future of the mentorship and all the things that we got planned, hopefully going into the new year. It's been a crazy, crazy busy weekend. I've sat with the team and we've had a big brainstorm session. And I apologize, I haven't been very active on the actual chats. With the migration, there is a lot of people who are now on the website, but they haven't opened a ticket to get back into the Discord server. So we have lost people from the chat, which, to be fair, I expected. We are working on making the chat room a lot more engaging, right? There are plans to incorporate a leveling system, a prize system. We're going to be doing, hopefully in the new year, once a month. I will be personally funding an account for somebody. You'll be entered into a prize draw, and there's a lot less people in our mentorship group than on social media, for example, so there's a higher chance of winning. Now, I've also sat down with the team and we are just reevaluating the way we do things. I am going to be employing more coaches to help with questions and the running of the chat groups, but the chat room will have a subscription to the Discord, which is going to be an add-on. Now, everybody who's currently in the mentorship, until we get this system up and running, you will all get the subscription for free. So you're not going to be paying any extra. It's just future people who are going to be coming into the mentorship. If they want to join our server and ask myself and our coaches questions and whatnot, they're going to have to pay a small fee to get into the server. And really, it's mainly just for automation processes because my admin staff are absolutely swamped at the minute. I have so many questions and messages from absolutely everywhere, from social media to Discord to emailing. And to be honest, I myself can't keep up with them anymore, which is why I'm trying to get more coaches on board. We have Mask, who's absolutely phenomenal. He's a brilliant young man who's going to go exceptionally far and is very, very knowledgeable. Of course, I personally taught him, so shout out to him for everything that he does for our community. 99% of questions he will be able to answer. Anything that he can't, he can tag me in a post and I can obviously answer. I'm trying to build the best ICT education platform out there, and it takes time. And I'm listening and evaluating all the feedback that I'm always getting. And since I released the Academy, there's been a whole lot of information that ICT has released. The Academy was created before he went public with everything. So there was a whole lot of stuff that I had a non-disclosure agreement and I couldn't teach. But that's out the window now, I guess, with everything being released for free. So I'm revamping the Academy early next year, and I'm going to do it in a bootcamp style. So around February, March next year, I'm going to run a 12-week, maybe 16-week bootcamp where I'm going to take you from the A to Z of ICT concepts and actually have a structured curriculum. My retention in the mentorship isn't great. And one of the main reasons is because it's quite an advanced level. Like, I'm blending many, 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 many different facets of ICT. And for people who are very new to ICT concepts, they are struggling, which is another reason why I want everybody on the same page. So this is why I'm trying to set up this bootcamp to get everybody again on the same page. And then going forward, I'm going to make slight changes to the mentorship that I think will benefit everybody. It's really not an easy process and it does take time. And we're still in the building phases of trying to establish this community. I have a whole massive list of still things that I need to finish. And at the same time, I'm still trying to have my own personal life. I'm still trying to revolve everything around my own personal trading. I have property that I'm currently working on. Sometimes I feel like I bite off more than I can chew, but my passion here is in the teaching. I love doing this. And I love seeing the light bulb moments that you guys also have. And this is why I've really delayed a lot of my stuff for YouTube and everything, because I want to focus on making sure my product is good first. There's a lot planned over the next year, and I'm constantly trying to find ways to improve this learning experience for you all. Once we finalize what we're doing, obviously I'll let you guys know. I thought I'd just drop that one in there because I've been getting quite a lot of questions about the Academy 2.0. Please bear with me while I get things a little bit more structured and organized. My second point why I wanted to talk about was I had a question from one of our students who asked about how do you conquer anxiety, both in the markets and in general. Now, we all experience anxiety from time to time, whether it's in trading or it's in our normal lives, right? The definition of anxiety is a feeling of worry, nervousness, or unease about something with an uncertain outcome. And in trading, especially, we are never certain of the outcome. Right? So that uncertainty causes anxiety in our trading. And sometimes you can carry that anxiety to your personal life. Obviously, my background was in healthcare. I actually specialize in mental health therapy. My A levels were done in psychology. So not only am I a trader, I also have a background in mental health. Most of my patients who really suffered from chronic anxiety, the main thing was this feeling of worry and uncertainty. And every single time, it was really down to overthinking, right? If you're constantly overthinking and you are constantly thinking about something negative, it's going to have a massive negative impact on you, especially the longer you live in this bubble of anxiety, right? Now, obviously, being in my job, we would give out anti-anxiety pills like sweets because it's easier to just mask it. But these patients of mine would be on these pills for years and years at a time, and the underlying problem would never really go away. To get to the root cause is understanding that you have to be completely present with yourself. The only thing that you can control and change is now. If you are continuously worrying about an outcome that has not yet happened, you're going to live in constant anxiety. So staying present with yourself and controlling what you can control and not worrying about the things you cannot control helps reduce that anxiety. And when it comes to trading, because we are always uncertain of the outcome, what can we do in the present moment to reduce that overthinking and that future anxiety? Well, we can backtest our models. The more we collect data and the more confident we are in our personal models, the less you're going to worry about the outcome because you have the data behind you to support. You know over X amount of time, your model, your strategy, your edge, and the larger your sample size, the more confident you're going to be in your own model and in your own trading. There is a paradigm shift that takes place where you have to get comfortable operating in a grey area. One losing trade, or even one losing week or one losing month, is not going to derail your whole career. Often, I've had losing months in a row, and I've still come out on top at the end of the year. Now, it's easy to fall into that anxious state where you've lost 2, 3, 4, 5 trades in a row and you think this is never going to end. And then the overthinking starts and you're fearful of getting into your next trade. You have to approach every single trade as if it's a new trade. The results of your last trade has nothing to do with the results of your next trade. And again, it's about being present, not focusing on the past that's behind you, and not focusing too much on the future or dwelling and overthinking of an outcome that has not yet happened. It also helps to journal your thoughts before you enter a trade. If you are feeling anxious because you're uncertain or you're feeling fearful, then there's nothing wrong with just tape reading for that session and building your confidence back up again. I went through a period of where I was in live funds and I became fearful of entering positions. So I went back to a demo account for a few months just to build my confidence again because I was in that anxious state of overthinking. I had lost a couple of trades in a row and I thought, that's it, my strategy has stopped working, my model stopped working. But that was just in my head because I was overthinking it based on a couple of trades, which is ridiculous if you think about it. How many trades am I going to take over a year? And I'm worried because I've lost 2 trades. So there has to be an element of reprogramming that takes place. So it's all to do with mindset. It's remaining present with yourself currently, controlling what you can control, and not overthinking the things that you can't control. And essentially, that is how you deal with anxiety, both in trading and outside of trading. So I could spend a whole hour just talking about this. So I hope that answered your question, and I hope somebody else managed to take something away from that. Anywho, in front of us, we have this current week's high impact news, right? So Monday, again, there's no high impact news for the US dollar on Monday. Tuesday, 10 a.m., we have ISM services and PMI. We've got 2 high impact news here at 10 a.m. on Tuesday. So it's something that I want to watch for. Wednesday, we've got the non-farm payroll employment chain, 8:15. So again, it's going to be an injection of volatility into the markets. And on Thursday, 8:30 a.m., we've got unemployment claims. On Friday, 8:30 a.m., again, a lot of high impact news at 8:30. We've got average hourly earnings, non-farm payroll, and the unemployment change. So this is all obviously within the NFP. So ideally, we want to avoid Friday, or at least wait until the non-farm payroll is out the way. And then at 10 a.m., we have the consumer sentiment that comes out. So our protocol for non-farm payroll is by Wednesday New York session. You ideally want to be out, or you do not want to add any more positions after that time. It's just a protocol that ICT did with us for many, many, many years. I'm not saying that you can't trade non-farm payroll. I have done so in the past. But when I'm doing it, I'm really reducing my risk a lot because we can get manual intervention. More often than not, you're going to find that it goes to logical levels. It's just that the repricing parameters of how high and how low the buy and sell programs, where they're capped at, it can be overridden and it can go much, much further than what we can anticipate. So in my opinion, it's not worth it. Generally, Monday, Tuesday, Wednesdays are the best times to trade. But being in December, where generally the market is quiet, and with not having any high impact news here for the dollar index on Monday, Tuesday, Wednesday is probably where your best setups are going to form. And you have to be aware that generally with non-farm payroll week, we're going to see the market manipulated. So there will be some level of accumulation, generally taking the market higher or lower during the early part of the week. And usually those stops are going to be run once the non-farm payroll figures come out. So you have to tread with caution, especially currently. Being in December is a very low probability month for myself personally. I am sidelined at the minute, so I'm not taking any live trading. I will start up again mid-January to February. So this is the time of year where I tend to take off. Anyway, let's get into the charts. That's a bit of a long-winded introduction. And yeah, I tried to get that out of the way early so then I can just now focus on these slides. So here we have the dollar index monthly time frame. Now, you can see how we've already dug up higher into this sell-side imbalance. And we've seen price run lower back through this buy-side imbalance. So we've had buy-side delivery here, and we've rebalanced with sell-side delivery. I am looking at this monthly volume imbalance at the minute, right? So this month we opened and gapped lower. We've already run higher, passing through this gap once, and into the opening of these two consecutive up-close candles. This was all consolidation over here, and it was these two candles that ran the buy-side liquidity and dipped into the sell-side imbalance. So I like the order block from here. I'm noting the sell-side liquidity below this monthly low over here. I'm also looking at the consequent encroachment. We can still dip lower and find support at the consequent encroachment, and on a lower time frame, if I see any sign of bullishness, that might want to be a catalyst to get either back up into the monthly volume imbalance or back up into this sell side imbalance over here. I do like the rejection block over here though, because again, I have mentioned that these bodies are very equal, and there's a big pool of sell side liquidity resting below these lows down here, and we also have a small portion of this buy side imbalance left open with this low sat above it. So there are quite a few targets for the downside. If we move on to the weekly time frame, now we have these two consecutive down close candles. Again, these candles ran the sell side liquidity below these relative equal lows down here. We also have this balanced price range. So we have this low, high, lower low, and inside of these three up close candles, which would be our breaker, we have this balanced price range. I like how we've dipped into that and ran higher. We haven't closed below it. So that's an indication of maybe potential bullishness. And if you notice the monthly consequent encroachment of the wick that we had outlined in the previous slide, it overlaps with the premium end of that balanced price range, right? So we have a few overlaps here of discount arrays that should hold as support. Now I'm keeping my eyes on this volume imbalance, which was the monthly volume imbalance. I want to see if we stay below it. If we get back above it, then we are likely to come up into this sell side imbalance and rebalance in some of this. And then I will want to see if we have the legs to get back above the sell side imbalance. And if that's the case, then we have these relative equal highs up here and the remainder of this sell side imbalance. At the minute, we are sat in a discount relative to this dealing range low to this dealing range high. I am noting this small sell side imbalance over here as well. Since we are at the beginning of the month, it wouldn't be unreasonable for us to travel higher, rebalance, and then continue lower. I am looking at this candle's high to this candle's low. This is an area of redelivered rebalance. I've mentioned this in previous lectures, and that area overlaps again here with this sell side imbalance. I'd rather see it left open, and I'd rather see price roll over and really make a run for these lows down here. That's what I would prefer. But it's December, and we are currently sat around equilibrium of this dealing range high to low and this dealing range low to high, right? So we could just chop about in here. And again, which is why it's low probability for me at the minute. I'm also paying attention to this thick red line over here. We have this sell side imbalance and we have this order block. The dealing range starts from this high down to this low. We drop through the dealing range here, but we're also sat inside of this balanced price range as well. So until we break out of this area, either higher or lower, I'm going to sit on my hands and wait for more information. This area also overlaps perfectly with the equilibrium from this dealing range low to this dealing range high. And inside of this range high to this range low, we have our equilibrium level over here. Also overlaps with that small sell side imbalance that I mentioned earlier. But I'm also looking at this high over here. We've already run above it, which is the upper quadrant from this high to this low. We've already run the stops below here, and now we've run the stops up here. So I would like to see this run lower for the sell side liquidity below here. We may just consolidate in this area throughout the rest of December. But if we do get any movement to the downside, I like to see price get back below this weekly balanced price range on a closing basis. And then this should hold as a brick wall to prevent us from getting any higher. At the same time, we could see a potential bounce back up into this sell side imbalance before continuing lower. So we could just knock about in this range for a while. Looking at the daily time frame, so last week we had identified this buy side imbalance with the relative equal lows over here is a pool of sell side liquidity. We have these two down close candles and order block, and this was our downside draw. So you can see how we really rejected from that here and ran higher. At the time of this recording, we have an outside day with an up close. Now, generally, if we are in a bear market and I see an outside day with an up close, that's usually an indication that the market wants to move lower. But we also have non-farm payroll this week. We are inside of these three consecutive down close candles, which is our distribution block. So I'm still bearish until we get back above this up close candle over here. If we get back above this high, then that would probably set us to fill in some of this sell side imbalance, and we have a pool of liquidity resting above that. But at the minute, we're failing to get back above the mean threshold of the distribution block. And inside of this distribution block, we have this buy side imbalance over here. Again, if you overlap that level, we get that higher time frame sell side imbalance, which overlaps with the equilibrium of this level. So there's a few areas over here that should really keep price held at bay and prevent it from going any higher. We still have the sell side liquidity below these relative equal lows and the monthly rejection block as well. Once this week's out of the way, we'll have more of a clearer picture for the rest of the month. Zooming here on the daily time frame, you can see from this candle's high down to this candle's low, we've already traveled up into a premium. We have these two up close candles as a bearish order block, and then we have this down close candle here as a bullish order block. So with the higher time frame balance price range, and between two order blocks, and between two volume imbalances, I don't want to do anything in here. When it's low probability conditions, when you're sat around equilibrium, where you are trapped inside of order flow between PD arrays, when you have high impact news towards the end of the week, like non-farm payroll, and you're coming off a higher time frame level, this is where most people who haven't got the experience, this is where they trip themselves up. So when I say it's low probability, well, these are the reasons why. I can make a case essentially for both sides of the market from where we are, even though I favor lower prices, with everything that I've already outlined in terms of seasonality, economic calendar, and where we are inside of the range. It's not worth me putting money into the market where it could go either way, right? Looking at the dollar index versus the euro versus the British pound, we can see the SMT divergence over here on the highs for the dollar index where we went higher and on the British pound where we went lower. But you could see the underlying accumulation. So there was institutional sponsorship behind the euro when price was down here, and it was clearly failing to go lower. And you can see the reaction that we had after that. Now, I like how we ran back through this sell side imbalance, which was inside of these three up close candles. So this is an important sell side imbalance for me. We've run through that and now we're finding support on it. So I would like to see price ideally stay above this sell side imbalance. This has become a balanced price range for me. It can come all the way back down to the discount end, but I would not like to see a close back below the discount end of this balanced price range. Similarly with the British pound, we've gone back above this small little sell side imbalance over here. I have outlined the relative equal highs on the weekly time frame, and I still believe that's probably going to be the longer term draw, and that would obviously only pan out if we have a lower dollar. Looking at the E-mini S&P, this is the daily time frame. So we've run the buy side liquidity that I outlined last week. I said we were sat over here accumulating, and I wanted to see a run above this high. We had left equal highs here. So from Wednesday, there was a large pool over here, and then they ran it Thursday, Friday, just dipping back above that buy side. We do have this small volume imbalance up here, and I think ultimately this is where we're reaching for. Doing some measurements, I'm looking at this high down to this low, and this is the manipulation that ran the sell side liquidity. So projecting standard deviations higher, 2.5 to 3 standard deviations takes us back above the relative equal highs up here. I like how the 0.5 level of this manipulation leg overlaps here with this volume imbalance. Now, looking across, I like this area as a measuring gap. Again, if you refer back to the market maker model, we look to the left side of the curve, and we have a small little breakaway gap over here. This becomes our measuring gap, and then ultimately we reversed over here. Now we've run back through that. I would like to see this remain left open at the minute, and if I anchor the one standard deviation which overlaps with that measuring gap, and I anchor it from this low to that one standard deviation, you can see how 0.75 of the level overlaps with 2 standard deviations, and 3 standard deviations will ultimately give us a measured move from this low to the measuring gap. It's not just about looking at the low of the measuring gap, the high of the measuring gap, or consequent encroachment, or even the quadrants. You want to refer to the PD arrays on the left side and see where our measurements overlap to give us confluence, right? This high to the first swing low after that high was created, we've got 3 standard deviations lower, almost nails the very low over here, right? So because the market moves in such symmetry, 3 standard deviations of this manipulation leg takes us up here, so 47.95 and a quarter. So this is a potential high-end objective for a buy-side target. I like how this candle here, see, this is the market maker buy model. We got the initial consolidation over here, and this is the highest up close candle to the left, right? So I'm ignoring all of this stuff here, and I'm looking directly at this one. If we extend that out, this is our accumulation block, and you can see how we're accumulating inside of that accumulation block, right? Finding support, bodies there telling the story that they're being supported by this down close candle. So this is our order block inside of the accumulation block, right? Also notice that 1.5 standard deviations, we're finding support there as well. So I want to see higher prices for the next week. The dollar index could still consolidate from where it is, and we could still see higher prices in the stock indices. Moving on, so this is the dollar index on the 1 hour time frame. On Monday, we have no news, and this was really just a seek and destroy. We're just running highs and running lows, so consolidation day here on Monday. On Tuesday at 10 a.m, we have the CB consumer confidence, and we have a range expansion. Notice in this case, the news acted as a catalyst to send price lower. We already had the change in state of delivery running into this sell side imbalance earlier on in the day, which also overlapped with this breaker and these 3 consecutive up close candles as our order block. On Wednesday, 8:30 a.m, we had again another high impact news. Now, the news for this day, after we had already run lower into the daily fair value gap, completely rebalancing that area, dipping back into the daily order block and touching the daily volume imbalance right there. You can see how we ran away from the area. We had a break in market structure and change in state of delivery. So we're going back and forth in this area. Again, seek and destroy, so very difficult to trade. On Thursday, we then have another expansion. So I said that we would probably see our most explosive move on Thursday because we had 2 high impact news coming out. You can see how we really expanded higher, came back down into this buy side imbalance, found some support here and then continued higher. And then on Friday, we had the Fed chair speaking. And you can see how we ran higher into a daily balance price range, running Monday's highs, and then coming off those highs and really sharply running lower to finish out the week down here. Now, if we look from Monday, we have our consolidation. We break the consolidation down here and we gap lower and then run higher, returning back into the consolidation, and we had a small imbalance over here, right? We then continue an expansion lower. We have our smart money reversal down here. We break in structure, have our change in state of delivery. On Wednesday, we retrace lower back into the discount end of the daily fair value gap and into this order block down here and into this gap that was left over here as well. Then Thursday, we've seen the expansion higher going back above the initial consolidation on Monday. Now, on Thursday, we made this high, but we didn't run a swing low and we didn't have a reversal profile here because we had the Fed chair speaking on Friday. So notice that we didn't run into the higher time frame level. So this was a daily balance price range and we just came off and consolidated. And then on Friday, because we didn't see a New York reversal on Thursday and we had the Fed chair speaking and we hadn't reached a higher time frame PD array, we seen another explosive move higher, running the stops above Thursday's high into that higher time frame level, and then we seen the market roll over, right? Notice how we ran below the weekly open and we came back above the weekly open and then we closed a week around here. So we had quite an indecisive week, which was the last week of the month, and we're going into December after having quite a large range month to the downside on the dollar index throughout November. So if you think about, again, the power of 3 for the monthly range, in the final week after we've already hit, don't forget, a higher time frame PD array down here, we're likely to go back up into the range and consolidate. Let's look at Tuesday's trading in a little bit more detail. So again, we had the 3 consecutive up close candles here. This was an order block that sat inside of this sell side imbalance. We had displacement and closed back below this swing lower over here. If we zoom in here to a 15-minute time frame, you can see how we had the 12 a.m. opening price. We had a Judas swing higher into the London session, rebalancing the sell side imbalance. We reject lower and consolidate between the 12 a.m. opening price and the hourly order block. And then we run higher back up into that sell side imbalance. And look at the bodies respecting the order block here in New York. And then you can see how we really travel lower into the London close. If we zoom in here onto the 5-minute time frame, and you can see this in a little bit more detail, the level that I'm most interested in is this buy side imbalance. This buy side imbalance overlaps with the higher time frame sell side imbalance on the previous day and that 1 hour time frame order block, right? This was the first major displacement inside of London. And this is going to act as a high probability inverse fair value gap when we get back up into New York. It's similar to ICT's Meduse, the PD array that he talks about with the fair value gap. And before he even spoke about that PD array, it was something that I noticed in price a long time ago, really. I'm looking for the first fair value gap inside of a session, and I want to see how price responds to that, right? You can see how we had at the end of the London session this displacement lower, and look at the price action around this area, right? So it's influential. All of this was kept inside of this sell side imbalance until we came to New York. So when time aligned, we had a run higher into this buy side imbalance that was created in London with everything else that overlapped. And you can see how the body's again telling the story and price really rolls over. After sweeping the buy side liquidity that was left between London and New York, so we went into a period of consolidation. So we already seen the change in state of delivery prior to 8:30. When 8:30 happened, we had a small little volume imbalance at that 8:30 candle. You can see how we were rejecting it here, and then price really delivered lower. 10 a.m. at the beginning of London close, you can see how we had another macro that ran higher back up into this order block, reject that, and then really run lower. The body's there rejecting the premium high, even though we sunk into it, but we still have time left in the day. At 11 a.m. we run higher, creating this high back into these consecutive up close candles, and then we have a high, low, high, high. So this last down close candle is our breaker. We really run into it there, reject, and then again roll over all the way into 12 p.m. where we have the end of London close. Went a little bit lower, touching the daily block just shortly after. But if we take this candle's high to this candle's low, and we project deviations lower, 4 standard deviations gives us 102.219. The actual close of this candle comes in here at 102.218. There was a whole lot of other measurements that you could have done, but this is already quite a long lecture today. But you can still see the precision, and hopefully you can see how the economic calendar plays an effect in market profiling for the week. You can see how the PD arrays inside of different sessions are sensitive, and you can see how when time aligns with these PD arrays is when we get an instruction or a macro that instructs price to do what it's going to do, right? So I hope you guys have found this one insightful, and I will catch you again in next week's lecture. Take care, guys.